Thank you for joining us for this New Capital webinar, Special Markets Update 2020, number 2 this week. This is Catherine Barr, Director of Communications at New Capital. If you have any questions during the presentation, you can enter them using the Q&A tool in the webinar menu, and Leonard will answer any questions you have at the end of the presentation. Before we get started, I'm going to make the following regulatory disclosures. This New Capital presentation is being made available for educational purposes only and should not be used for any other purpose. The information presented does not constitute and should not be construed as an offering of advisory services or an offer to sell or solicitation to buy any securities, related financial instruments, financial services, or other services in any jurisdiction. Past investment performance is not an indication of future results. Wherever there is the potential for profit, there is also the possibility of loss. Certain information contained herein concerning economic trends and performance is based on or derived from information provided by independent third-party sources. New Capital believes that the sources from which such information have been obtained are reliable. However, we cannot guarantee the accuracy of such information and have not independently audited these sources. Okay, thank you. And now I'm going to turn it over to Leonard to get started.
Thank you, Catherine. Hello and good afternoon, everybody. I hope you are doing well. Been quite a week, right? All right, let me get my video going here. All right, there we go. So I hope everybody is doing all right. And in this unprecedented time with this virus that appears poised to spread here in the United States, I hope everybody is doing what they can to take care of themselves and take care of their families. I'm not going to spend any time on the virus today. You've got the information I've got the information you've got. I am not a virus expert. On the last call, I discussed it a little bit, and as I say, we all are getting a lot of information on that. So I'm going to stick to financial comments today. Obviously, a very, very volatile week for the stock markets. And I'll put up the, I'm going to share my screen now and put up the map that I showed. So this is today. And so let's just look at some of the results today. Look at this, JP Morgan, 18% up today. The banks have really been hit hard, but look at today, up 18%. Bellwethers, Apple, up almost 12%. Microsoft, even the oils here had an update. What did Exxon do today? It's not telling us, but so obviously a big day. I think the S&P 500 ended up about 10% for the day. So I think everybody was ready for an update to go into the weekend. I could have taken another down day. I'm like that, but I think most people were probably ready for an update. And then it was also a good day for the world. Here's the world map, and you can see lots of green across the world as well. So it appears that markets are responding positively to at least nascent efforts by the United States government, European governments to get a hold of this thing, get a handle on it. Of course, the news out of Washington is that there are ongoing negotiations between Nancy Pelosi as the Speaker of the House and Steve Mnuchin, the Secretary of the Treasury, to try to get a package. It looks like it's going to be about $50 billion, and we'll see what happens there. The big push now, obviously, is to get some testing going in the United States. What I want to do today is I want to talk about valuation of the market. And I've built this spreadsheet to do that. And by the way, if you've got any questions during it, I guess you can shoot them off. There's a hand raise thing. I haven't figured out how to use that yet, but this is a spreadsheet I built to try to help everybody understand how the market is valued. And I feel that this is an important thing to talk about so that you feel comfortable when the markets get crazy. You understand what it is that the market's trying to do. We want to talk about how to value the S&P 500. I could value the S&P 600, which is small companies. I could value the S&P 400, which is mid-sized companies. I could value international stocks. I could value your business. I could value any business. I could value bonds. I could value real estate. It's pretty much all done the same way with these basic elements that you're seeing on this spreadsheet. Right now, we're going to value the S&P 500. And as I was saying, the reason I want to go through this with you, and it looks technical, but I think you're going to get it pretty easily. I want you to feel confident that as the market does its volatile stuff, I want you to be confident that what you own has real value, that it's not just poof, can be something that totally evaporates. And I think that if you're empowered with that information and you know that, then you and our clients are going to be able to stand steadfast as this virus progresses and the markets react to it. By the way, I want to say we got fantastic clients. We heard, really very little, barely a peep this week from everybody. I think people are tuning into the webinars and to the extent that I'm writing, and I want to do more writing, but it's really time consuming. We've been really busy this week. I think the busiest people this week have been the doctors, the stock checkers at the grocery stores, especially those that handle the sundries, toilet paper and alcohol and all that stuff, and then the financial advisors, three busiest people this week. Okay, so let's get to it. Let's first talk about the 10-year Treasury bond. And that's the first thing you see here in green. The 10-year Treasury bond is known as the risk-free instrument. I talked about this a little bit in the last webinar, but and there's debate about what's the risk-free instrument. You'll get some professionals saying, well, no, it's not the 10-year Treasury, it's the 1-year Treasury or the 30-day Treasury. But in general, for longer term investments, the 10-year Treasury bond is the benchmark. And everything is priced off of the 10-year Treasury. What is the spread between a junk bond issued by a corporation and the 10-year Treasury? Well, the spread between what the two yields are, that gives you an idea of how much more risky the junk bond is, right? It's got to pay a higher rate of interest because it's a bigger credit risk. Okay. Right now, today, the 10-year Treasury closed at 0.98%. That was the close. Remember, earlier in the week, it's been as low as like 0.5%, even below that. So that's a pretty big move this week to pull back from the brink of this panic that happened earlier in the week. That's a big move for the bond, the 10-year bond, to end the week at 0.98%. Call it 1%. Okay, so that's the baseline of where we price risk. All right. Now, next, the question is, well, what is a risk rate for equities, for stocks? We call that the equity risk premium. And I want you to think about this like a layer cake, right? The green is the bottom of the layer. That's the first interest rate. The yellow is the next, the equity risk premium. And what we're getting to in orange is the discount rate, the sum of the two of these things together. Why do we need a discount rate? Well, the discount rate, any asset that you are trying to discount its future cash flows, you have to have a discount rate to discount it back to the present, so we can see what something's worth in the present that we're going to get in the future. We have to discount it back because $1 today is worth more than $1 tomorrow. So we have to figure out, what is that dollar tomorrow worth in today's terms? And we have to use an appropriate discount rate to get it back to today's terms. And different assets have a different discount rate. We don't want to discount the earnings of a company at the same rate that we would discount the payments on a 10-year treasury bond, because there's more risk to the corporate earnings than there are to the 10-year treasury bond, theoretically. And actually, usually that's the case. So getting an appropriate discount rate is what we have to do. Well, what we call the equity risk premium. What has historically, or right now, the premium for holding stocks over the 10-year treasury bond? Does that make sense? What is the rate of risk? Well, historically, it's been between 3.5% and 10%. Right here. Anywhere between 3.5% and 5.5%. Excuse me, I misspoke. 3.5% and 5.5%. And we might say that right now, given this time of distress in the world and with the coronavirus, we might say we want to be really conservative and we want to take a very conservative discount rate. So let's take 5.5%. All right, everybody? So we're going to take the current 10-year treasury yield plus the equity risk premium at the high end of the spectrum, and we're going to get to a discount rate right now of 6.48% as we work to value the S&P 500. All right? And I guess if anybody's got a question, just shoot it in, or if something's not clear, or maybe raise your hand. I think there's a hand raised, and I can see you do that maybe. Let's see. I might be able to see a hand raise. If not, Catherine can maybe help me. But if you need to stop me, oh, there it is. I can see the panelists here. Okay. So if you need to raise your hand, just raise your hand, and I think I can see you. But right now, I think everybody's got it. We've got a base discount rate and an equity risk premium discount rate, and we add those two together to get to a total discount rate. And we're going to use that discount rate to discount the future earnings of the S&P 500, the market. Now, we also are going to need a growth rate. I don't want to talk about the growth rate right now. I'm going to come back to it, so hold off on that. The current price of the S&P 500 is in purple. It ended the day at 2,711. It started the day at 2,420 or something like that. Big up day. We talked about that. It's a big up day. A 10% up day today is a very big up day, right? I don't know. I think this may have been one of the biggest up days since 2008 or something like that. So everybody who sold their stocks yesterday missed a 10% up day today. We're going to ignore the next, which is the total present value in that sky blue. Hold off on that. We're going to come back to it. We're going to not worry about the fuchsia for now. Now we get to the heart of this here. All right, everybody? Bear with me. Here's my table. Now, how long should we take a look at the earnings of the S&P 500? Well, I don't know about you, but I'm planning to own my portfolio for a long time. I'm 54 years old, 30 years, maybe longer. And so I'm looking here at the table that I've made. Again, I've done all this by hand, 2020, and as I go down, you can see my spreadsheet going down to the year 2050. I've got 2051 here, but we're not going to worry about 2051 yet. We're just going to 2050. And for each of these years, I've given you an earnings. The earnings on the S&P 500, and it starts at 174. Where did I get the number 174? Well, now let's turn our attention to this chart. This comes from our friend Ed Yardeni. I mentioned that in our last conference call. Let me turn on my drawing tool here. All right, there's my drawing tool. And this starts in 2003, and here we are in 2021. Well, we're not in 2021 yet. So this is a chart, and I showed this the other night, of consensus forecasts. So this is all the gurus who sit and monitor what these very large American companies are doing, and they come out with forecasts. And you can see that, boy, the thing fell off a cliff back in 2008, literally. right? What was the level of S&P 500 earnings at that time? It was right about there. Call it 100. And the earnings fell off a cliff and hit a trough here in 2008, 2009. Let's call it 60. So that was a huge drop in earnings. That was a big recession. Earnings for the S&P 500 fell by 40%. So keep that number in mind. That's what a big drop-off looks like. Are we going to see that this time? I don't know. That's the big question that all these analysts are asking themselves right now as people cancel their airplane reservations and their cruises. You know, we don't know. On the other hand, some businesses are doing better. If you're in the grocery store business, wow, you're hitting lights out. So what the net effect is going to be of business lost in the travel sector versus what happens in other sectors, I don't know. But this is what all the analysts are trying to figure out. How big do we take a hit and how long does it go? We can see that this hit back in 2008 started right here, right? And it wasn't until about here, 2011, 2-3 years later, that the earnings per share for the S&P 500 made its way back to its prior level before the big dip. Now, where are we now? Well, we're up around here, around 175. And the estimates for 2020 in February of 27th, the estimates for this year were at $175 a share. $175 a share. Now it's fallen. March 5th was the last reading that was taken of all the gurus. 174.44. So it slipped some. When the new numbers come out from Ed next week, I wouldn't be surprised if that 174.44 has slipped. But for right now, that's what I'm using. That's where I got the 174. Okay, everybody? That's where I got my estimate for the earnings on the S&P 500. Hopefully all that's clear. That's the current estimate. Maybe it's right. Probably going to fall. But right now, that's what I'm using. All right, I got to move this out of the way now. Now back to our chart. All right, so there's my 174 in earnings. Now, what does that 174 mean? Well, the current price to earnings, that is, and I'm going to do some more drawing here. That is this. Oh, shoot. Does that not work? What? Drawing. Draw. Okay. The price to earnings right here, 15.6, is simply the $174 per share divided by this 2,711 current price, right? Or sorry, the other way around. That's the 2,711 divided by the 174. So you are paying, when you buy the S&P 500 at $174 a share, you're paying $2,711, which is the closing price on the index today. You're paying 15.6 times what the earnings are expected to be. We don't know what they're going to be. I'm using the 174. And what does that mean in an earnings yield? Well, that means 6.42%. Looks suspiciously close to this discount rate that we built, doesn't it? Yes. What this is, the earnings yield is 1 divided by 15.6. So that takes the earnings and it turns it into a yield, the way you would look at the yield on a bond. It's the earnings divided by the price, right? PE turned on its head, E divided by P. And that's a useful way to look at it and say, that's kind of the yield that you expect to get, 6.5% if we buy the index right now and we get $174 per share earnings. All right? One more thing. This present value right here, right? I've got earnings, I've got present value. And what is that? Well, if we take 2026, for example, we're expected to earn right now, if we grow at a 3.5% rate, $213. So here comes the growth rate. Remember I told you I was going to come back to the growth rate? Well, what are we getting here on 2021? If we start at $174 in 2020 and we grow it, that earnings at 3.5%, it's 180. And the year after that, 186. And the year after that, 192, 199, and so on. That's if the 174 actually materializes here in 2020 and we get some growth in the future years. And generally, stocks have grown, companies have grown. What is 3.5% a reasonable rate? Well, Robert Shiller, who's one of the great, I think he won the Nobel Prize, has looked back and seen that if you go back a couple hundred years, the average growth rate is 3.5% for earnings. But take a look at this. Now we're back to Yardeni. This is another chart from Ed Yardeni, and this is looking at S&P forward revenues and earnings dating back to 1979. And so what we can see here, this line right here, this straight black line going through it, is a 7% growth rate, not 3.5%. So stocks have done more like 7% in their earnings growth dating back to 1979. It's been a very strong period for corporate earnings. It's falling off the pace here a little bit. You see that? So maybe it's not going to be 7 going forward, but that's what it's been. So a 3.5% estimate of a growth rate is a pretty conservative estimate by recent historical standards. But you know what? Let's do it. Let's take a really conservative growth rate. Now let's go back to where we were looking at this. I'm going to clear my drawing and back to the S&P 500, right? So what do we have? We've got a conservatively estimated discount rate, right? Because I took the high end of the discount rate at 5.5%, and now I'm giving a growth rate that's 3.5%. So that's pretty conservative. I just showed you that on the Yardeni graph that 7% is what things have grown at since 1979, and I'm cutting that way back. All right. So we've got a high discount rate and a low growth rate. Okay. Now, what the question is, what is in today's dollars? In today's dollars, what is this $213 in 2026 worth in today's dollars? Anybody? How do we get that? How do we get to that? That's a tricky question, right? How do we take something in the future? And this is the fundamental equation in finance. If you don't know anything else about finance, know this, and I'm going to give you the equation. Here we go. Can I draw? Okay. Ready? Here it is. I'm going to just draw it smack over the screen here. PV is equal to FV divided by 1 plus R. That's an R. That's the 1 plus R raised to the N. This formula is the E equals MC squared of finance. And what it says is that the present value of a cash flow is equal to its future value divided by 1 plus its interest rate raised to the power of the number of periods. This is the way that we take and we compound the present into the future, right? We compound interest forward, or the way that we discount back a future value to the present. What an incredibly powerful thing this formula is. It's like a time machine. This is a financial time machine, and it gives us the ability to take a future value, such as this $213 to be earned in 2026, and it brings it back to the current world, the current time. How do we do that? Well, we go back to our old friend, the discount rate. This is the discount rate. And so what I'm simply doing here in this column of present value is I am taking this $213 taking all these variables here, and what does it give me when I spit it out? $146.73 in today. As I sit here, and you sit here with me, that is what? $213. $213.90 in the year 2026. That is what it is worth in today's dollars, discounted at 6.48%. I think that is such a powerful idea. And all of these numbers here, all of these numbers for these future earnings going all the way out for 30 years, I am discounting back to the present. And then I am adding them up right here. And I am saying that is the total value of the earnings of the S&P 500 in today's dollars, if these earnings materialize. Well, that's why the market's gone berserko in the last few weeks, because everybody's saying, well, this is what we thought the world was going to look like earnings-wise until a couple of weeks ago. Now we don't know. So you know what? Let's you and me make some really pessimistic assumptions and see what the value of the index might be. Here we go. I've already told you that we have a conservative discount rate, 6.5%. The 10-year Treasury at currently about 1%. We don't need to speculate about that. That's what the market has said the bond is trading at. The equity risk premium, I told you we took at the higher end of the spectrum historically. We get to about a 6.5% discount rate. We have a 3.5% growth rate, half the 7% on the Yardeni graphs. All right. Now, let's assume earnings get cut in half this year. All right, everybody? Just destroyed. The S&P 500 earns half of what they thought it was going to earn. With me? It doesn't earn $174. It earns, let's say, 85. Actually, before I do that, let me go back to the 174 and let's look at what the prices are, or what the discount is. Under that, the total present value at 174 with a growth rate of 3.5%, we're getting a present value of $43.33 versus the current price of $27.11. So I'm getting a bigger value given these assumptions than the current price. Now, one thing I want to point out, if I go to the bottom here, I'm assuming that in 2051 I get a terminal value for my ownership in the S&P 500. I've got all these earnings that continue to pile up, but I still own the stock, right? At the end of 30 years, I still own the index. Now, maybe I choose to keep going at that point. I continue to earn it, and it continues to give me earnings. But I may also say, all right, I'm done with my investment, and I want to sell my investment. Well, let's assume that the S&P 500 is going to continue to produce earnings. So it's going to have value if the S&P 500. Now you see why I diversify you. Because if it's one company 30 years from now, I don't know if that company's going to be there. Who knew that Carnival Cruise Lines may not be there 3 months ago? Right? Or Fannie Mae wasn't going to be there in 2008. The reason I diversify you is so that 30 years from now, I can tell you, probably the S&P 500 is going to be there. Right? We're going to lose some folks along the way, but more than likely, we're going to pick some up too, and some will still be there. So we're going to say that the S&P 500 is not going to be gone, and it'll still have some value. And I'm going to say that in that year of 2051, the value of it's going to be conservatively 10 times the earnings of that year. $488 is what the earnings will have grown to at a 3.5% growth rate beginning in 2020, right? So I'm going to say I could sell my share in the S&P 500 at that time at $48.83. All right? What is that worth in today's dollars? This is called the terminal value. Well, in today's dollars, it's only worth $696.74. Remember, everybody, you have to discount that 4883 back to the present so I can see what it's worth today. So that number is included in the value up here, right? Up here at this 4333, where I'm saying if we get $174 right here in earnings this year in 2020, and it grows at a conservative 3.5% rate from there until 30 years out from now, and I sell my share 30 years from now, all right? And I discount all of that right here in column C back to the present, I get 4333, and the index closed at 2711 today. That looks pretty good to me. If these conditions materialize, I'd say that looks pretty good. That's a 60% discount, the current price to what we just calculated the value is. Now, before you run out and tell me, I want me to buy stocks, let's see what the market's seeing. And for people who say the market is not working right now, the market's working perfectly. It's doing exactly what it's supposed to do. It's supposed to take all the concerns about the virus and all the other stuff and change values. Stocks are clearing, right? Trades are getting made. People who want to sell are selling. People who want to buy are buying. The market's doing its job. It's not going crazy. So when you hear that, the market's going crazy, say, the market's doing exactly what it was built to do, to discount news and information coming out about the virus and the follow-on economic effects, all right? So now that I've given you the baseline, all right? So what do we have here? We've got a baseline of 4333. Got that? That's the baseline. Now let's take a worst case value. Now we're ready to cut it in half. 85. Earnings get destroyed. And why is that a good guess? Because we know going back here what earnings did. They were down. You want to go back to 2008? We could cut them a little more. Fine. Let's say it's going to be 70. It's going to be a 60% cut or something like that. It's going to look like this. Earnings fall off a cliff, just like it did in 2008. Now, the question I have for you is that what the economy is going to look like going forward with this virus? Let's all think about this. We're going to lose more than half the earnings this year because of the virus. Is there going to be a recovery in earnings? Well, if we don't get a recovery in earnings ever, if we don't get this, right? We don't climb out of this cut to earnings. It hits here and then it doesn't recover very rapidly, meaning we don't get a recovery. We've always gotten a recovery from a recession, but let's say we don't get a recovery. This would be sort of the worst case, wouldn't it? Somehow the virus takes out half the economy and it stays taken out. And we limp along from there at 3.5% growth from there on. That's like the worst case scenario. What do we get? Right here, 1743 on the value. Then the market does look expensive, right? At a 2711 current price, if this worst case develops where the earnings get crunched and we don't really get any recovery. I don't think that's, however, likely. Most people watching it think we're going to get a pretty quick bounce back. It's not going to be like this in 2008, 2009, because this is a health emergency. It's not broken banks and a banking system that's broken. It's not a financial crisis. It's a health crisis. And if the health crisis can resolve, and I'm not saying that it will quickly, I'm not an epidemiologist, but let's assume we get a vaccine. And let's assume the economy begins to recover. Let's say it recovers a bit like this. So let's say it takes 3 years to get back to where we were. All right? So 70, and then let's say it gets back to 100 the next year. And then let's say we get to 130 the next year. And then let's say we get to 160, right? We're still not back to the 174 that's being predicted for right now. Let's say that happens right here in 2024, 174. We finally get back to 174 here in the year 2024. It's a slow recovery. Then what do we have? 3606. Still pretty good versus the market. So this is, we'll call this slow recovery. All right. How about fast recovery? Let's say that we get hit with a 70, and then the next year we're back to 150, and then we're back to 174 the next year. In other words, 2021 is the recovery year, and then we're fully recovered. And then hang on, I've got to make some copies here. Okay, that gives us a value of 3936 on a fast recovery. All right, you see what I'm doing here? Now, what if we get higher growth, right? Along the way. Let's say we don't get the 7% that the market has experienced recently in the last 30 years, the economy has experienced recently. Let's just say we get a 5% growth rate. Now what? All right. So this would be fast recovery with higher growth is giving us 4866, right? So you can see that of all these numbers, the baseline case, the worst case, the slow recovery, the fast recovery, and the higher growth, only one of these, this worst case, do we see a value for the market that is lower than the current price. Okay? So now you see how we might go about looking at the market. And so what you think about stocks and what you think about the market should be intertwined with what you think about what the economy would look like. Now let's say we don't get a huge steep fall off like we did. We may. I mean, this may be where this is all headed in this recession. But you know, let's say it doesn't go down to 70. Let's say we go to 120 or something like that, right? 49.16 now, right? Let's say we go to 120, and then the next year let's say is 150, and then anyway, we're coming out somewhere around, you know, values of around 5,000. You know, it's pretty compelling. Now, let's look at the 30-year Treasury bond. Now I want to show you what a bond looks like when we value the bond. All right, so we go over to this. It's simpler. Why is it simpler? Because we know what the bond's going to pay us. We don't have to think about earnings. This is why stocks are riskier, because stocks are based on their earnings, and the earnings can be all over the place. The bond is an agreement to pay somebody a specific contractual amount. So it's pretty straightforward math. So let's look at an investment now in the 30-year Treasury bond right now, what that looks like. All right. The 30-year Treasury bond at the end of today was yielding 1.6%. There is no equity risk premium, right? It's not a stock. So the discount rate is the 1.6%, right? Although actually, yeah, we'll use 1.6%. Is there a growth rate? There's no growth rate. You're going to get paid your interest on the bond, and that's all you're going to get paid. You're never going to get paid another penny more than what the bond pays. If they issue the bond today, the government said we're going to sell 30-year bonds, it would be $100 is what you would pay, par value, right? The retail price for the bond, $100, all right? We're going to skip these for now and go take a look. All right, same thing, 30 years, right? And every year, your earnings on that $100, you get $1.60 because it's a 1.6% interest rate. You get $1.60 in earnings every single year. And then we discount all these future earnings at the discount rate of 1.6%, which is exactly the same, right? Look at the price to earnings ratio, 63. You're buying an investment that is trading at 63 times its earnings, and of course the earnings yield is the same thing. It's the interest rate, right? Does that look very appetizing to everybody? You get your $1.60 every single year, and at the end of it, you get your bond back. You get your $100. You get your $100 back. Presumably, the U.S. government will be good for it. Your bond will come due. And when all of this is added up, here you go. You paid $100, right? Pretty good. Total value, $101.60. That's the sum of all of the present values here that you're getting paid. So you are spending $100 to get something that's worth $101.60. Pretty good, right? Really appetizing. So this is what we are looking at now in the world of investments, given these very, very low interest rates, and why we're getting all this volatility in the market right now, because nobody's sure what these earnings are going to look like. But what I've tried to give you today are some scenarios, some pessimistic scenarios, and you know, I understand if the worst case develops and this virus takes out the economy and it never recovers, okay, you know, I don't know if we're headed for that. It doesn't seem to me that we would be headed for that. But sort of anything short of that, and there's a rationale to buy stocks right now, I believe. I'm not saying it should be 100% stock portfolio. I'm just saying at least there's a rationale for everybody on this call to hold your investments in these businesses. I think there's a very strong rationale. I'm doing that. Why am I doing that? Because of this. These are the numbers. And because the virus is spreading, it's not causing me to want to go out and sell my house and to sell New Capital Management. You all would think I'd lost my mind if somebody said, okay, the virus is out. What are you doing? I'm selling everything. I'm selling my house. Actually, I got a couple of houses. I'm selling all the houses. I'm selling all of my ownership in New Capital Management, and I'm selling my stocks too. Wow. So that pretty much does it for my comments right now. I want to open it up to questions. My hope is that this will show you that there are numbers, and that what the market is doing with participants all across the world is doing its job to work with these variables to see what does everybody think about what the future holds. But it says to me that there's a pretty compelling case to, at the very least, continue to hold your investments in stocks. Where they're currently valued is not at all any sort of obscene valuation, and under certain conditions of growth, it could even be regarded as being fairly inexpensive, and this goes for other parts of the world as well. And we are going to make this spreadsheet available to you. If you haven't seen enough of it tonight, we're going to put it in the replay, and you can download it and play with it yourself. So, okay, happy to take any questions. Okay, one person's got their hand up. Okay, David, go ahead. What's your question? I think you can type it. Can you type it in? Go ahead, type in the question. Will that work? Catherine, why don't you jump back in if you would, and
yeah, it looks like we've got a few questions. You're going to have to type them into the Q&A. So at the bottom of your screen on the menu, you should have a Q&A option. Open that up, type it in, press enter, and then we will be able to read it and answer it. You also can write it in. It looks like David wrote it in the chat function. So we'll go ahead and get started on that question. It says, if grocery stores
okay.
are, quote,
Great, fabulous question. If grocery stores are killing it, why not buy Costco or Whole Foods? First of all, Whole Foods was already bought. Lock, stock, and barrel by Jeff Bezos and Amazon, what, a year ago, 2 years ago? So you can't buy Whole Foods. You can buy Costco. And you could buy Costco, but what do you think the market has done to Costco's share price since the virus broke out? David? What? Let's take a look. Let's see if we can answer our own question here. Let me go here. Cost stock price. Okay. What's it done year to date? Well, it's been pretty steady. What's it done over 1 year period? So it's been good. A lot of stuff has been good. What's it trading at? Price to earnings. Here we go. So it's trading at 35 times earnings. Pretty expensive. Anyway, my response to that is that the market knows, right? Let's take a look at this chart again. The market knows. Look at the market's already reacted. Let me go back to the S&P 500 here, and let's look at what things have done year to date. All right, look at that. ExxonMobil down 45% year to date, just destroyed. Right. So that's the reason we don't run out and buy Costco. The market is reacting, and the market has already discounted for the news. So in the same way that it may have bid up Costco, it's going to have taken out the oil companies, so that's why I diversify you. I don't assume that I know anything more about Costco than the market knows. And as far as I'm concerned, the market has got to be putting a fair price on Costco. The market has evaluated that Costco's, doing really well and selling a lot of stuff, and it bid up the value of Costco. And it's evaluated that Exxon is having a tough time with this developing price war between the Russians and the Saudis, and it's bid the price down. So the market does its job. And so it's not my job to go out and try to put you into Costco, assuming that I know something more about Costco than the market does, or that Costco should occupy more of your portfolio than it occupies in the market. So that's the answer. I hope that makes sense. I'll chase my tail all day long trying to chase what I think is undervalued or has a bright future. The market does that. So we own the market. Hopefully that answers the question. All right, who's next? Catherine, next question.
Yeah, we've got a question that came in on the Q&A. It says, have bond funds bought years ago gone up in value during this crisis?
Yes, no question. Your bonds have made money this year. Your bonds are up 5% this year. Your stocks are down, I don't know, 10% after today. We had a 10% update today. So let's say the market was down 20% year to date starting today. And, we took 10% loss off the board. Stocks are up, bonds are probably up 5%. So that's a 15% difference between stocks and bonds. So no question about it. The bonds have done their job this year. Yes, they have given a lot of stability in portfolios this year. So they've done their job, but boy, it's hard to see them. It's hard to see much juice left in that lemon. So that's the conundrum for me as your advisor. What am I going to do about bonds? And I'm doing a lot of thinking about that. Lots. Other questions?
Yeah, we've got another one that came in. It says, why not use the volatility of the market? Day over day, we have about a 10% difference. Say you sold some today and buy when the market has taken another 10% plunge, which it most likely will as Krona gets worse in the US.
So whoever asked that question, I want you to, we're going to set up another account for you. And we're going to put some of your money in it. I don't know, $1,000. And you're going to do that. We'll see who wins. We'll see who's out of money first. My guess is it's going to be you, and pretty quick. Because all academic studies, finance academics have tried to see if people can do that. They've tried to see if professionals can do that, professional traders and so on. And the academic evidence is that nobody has that ability to guess where the markets are going to go. Nobody has the ability to guess where they're going to go in the short term. And moreover, the statisticians have shown that the next move in market is as likely to be up as to be down. That's a famous discovery, that the short-term market movements are what's called a random walk. In statistical parlance, that means that there's no statistical significance. You can't glean any pattern whatsoever in a random walk. So long-term is the only way that we can invest. It's the only way where we know that there's a signal. The signal is over the long term. The short term, it's all noise. So I can't take that. I can't behave that way because I'll lose all your money. That's why.
There was another response to the question one above. It says, have bond funds bought years ago gone up in value during the crisis? The follow-up to that question is that why you're selling bonds now?
Well, I wouldn't say I'm selling bonds now. I've sold some bonds. There are some bonds I'm selling. The problem is that yields on bonds are very low, and so bonds have as a source of return they appear to have limited returns from here on out, right? I've been trying to make that point now for two webinars. The 10-year Treasury bond's at 1%, and so its return is going to be 1%. We know that. It's not like it can grow like a stock. It's not a company that's making products and can come out with some new whiz-bang thing. It's a bond. So the yield on the 10-year bond is 1%. And as I said, if we go back to 2000 in the tech bust, another big drop in the market, the NASDAQ, everybody was investing in tech back then. You may not remember, but the NASDAQ stock market fell 80%, 80% in 2000. So overvalued were tech stocks. And at that time, you could buy the 10-year Treasury bond and it yielded 5.5%. So the 10-year Treasury bond was a very, very attractive alternative to overpriced stocks at that time. Not so now. Now it's 1%. So that's the problem. It's not that there's anything wrong with bonds or bonds are broken, or it's not that. It's just that they've gotten so expensive. And they're expensive for a number of reasons. We've had, as I showed at the last webinar, and by the way, if you missed it, you can watch a replay of it. But one of the first charts I showed was the fall in interest rates from 1980. So we've had 40 years of falling interest rates, and that has driven up the price of bonds, right? Again, bond yields and prices are inversely correlated. As bond prices go up, bond yields go down, and as bond prices go down, yields go up. Well, we've had falling yields now for 40 years, and so bond prices have gone up and up and up and up and up. So bonds are expensive. Not all bonds, most bonds. Those bonds that may not be expensive right now are lower credit bonds, right? We have seen over the last few days, whenever you get these sell-offs in stocks, you also get a sell-off in junk bonds, corporate bonds that are low credits. So those may be more attractive right now, but that's a very small segment of the bond market. Okay, any other questions? We're getting towards 7, and I promised I wouldn't go much longer, but I do want to see if there are any other questions.
There's not right this moment.
Okay.
We can leave another minute or two. I would like to the evaluation survey. I'm going to actually share a link into the chat feature. So if everyone would please take just 1 minute and complete the survey. This link that I just sent out should give you access to that. If you could take a minute or two, very brief, and fill that out for us, we'd appreciate it. And we'll wait on the line to see if any other questions come through. But that is, oh wait, okay, we actually do have a new question. So we'll go ahead and get that going. It's another response from a reply from the previous one. It says, but bonds that were bought years ago have higher interest rates compared to today's 1%. So why sell those?
Because they've gotten expensive. The interest rate on the bond when it was issued is the coupon rate. Okay, everybody, you've got to distinguish between the rate of coupon. That's what the bond pays and the price you pay to buy that bond. When that bond was issued, let's say in 1980, and it was a 30-year Treasury bond, it was issued at $100 and it yielded 15%. The coupon was 15%. It still pays the same $15 coupon, but that bond, let's just say, is now $200 in value. So to buy that bond, to get that $15 coupon payment, you're now paying twice as much for the bond. It's the yield that matters on the bond, because it's the yield that reflects the current price on the bond. So we can't look at what the coupon on the bond is. The bond may say 8%. Fine. What are you paying to buy the bond? You're not, if it's being sold in the secondary market, which is where most bonds are being sold. They're not being issued right now. They've been trading for a long time and they're being sold in the secondary market. The question is, what are you paying to buy that, to buy that 8% coupon? And right now, I can tell you that anybody who's issuing a bond with an 8% coupon is a big risk. Because if you're a strong credit, you don't have to pay 8% interest rates to a lender. So you have a very risky bond at 8% now. I hope that helps. Explain it. You've got to distinguish between the coupon and the yield. Those are two completely different things. Don't make that mistake. It's price that adjusts, right, after the bond has already been issued. Okay. I want to thank everybody. I hope it wasn't too turgid in the math. I really tried to make it a kind of straightforward spreadsheet. I hope I did. If I didn't, please tell me in the review so that I can try better next time or make an adjustment. I really want to know if this presentation, landed with a thud or whether some lights went off. And not all the lights had to go off. That's fine, but a few lights would be good. And if you have follow-up questions about the spreadsheet or the presentation that you want to ask me, fine. I'm happy to do it and we can talk on the phone, or I'm happy to pull it up on the screen again. We're going to make the spreadsheet available. I hope everybody has a fabulous weekend. I really am glad the market had a strong day. I think everybody needed that today, and I'm glad that materialized. But we all need to be prepared for some more down days ahead. And please, everybody, take care of your health and do whatever you need to do that. Our family is going to go to Colorado. We've decided we're going to get on a plane on Sunday. We feel comfortable taking that risk. We've looked at all the different analysis. Our family owns a home in Breckenridge, so we've got a place we can go that's ours, and we've got a way to get there that's ours, and we feel comfortable taking the risk of getting on the airplane. I will be there next week, but I will be responding and watching markets, and taking my phone on the ski slopes. So please do not hesitate to ask me. Also, a couple of other things real quick while people are still on. If you need to make an adjustment, this sounds kind of morbid, but if you are not sure that your medical power of attorneys and other things in your estate documents are the way you want them to be, because we all right now face the possibility we're going to get some virus that's going to do a number on us. Please make sure that you do whatever update you need to. If you're not sure, then review it with your estate attorney. If you don't have an estate attorney and you want to get some reviews, we can help you. We've got lots of names that we can give you. So please, I want to remind everybody to do that. We ought to send out a notice on that to please review your medical power of attorney and your directives. Good time to do that. I'm going to do that. And then the next thing I want to say is thank you very much to Catherine. Catherine put all of our webinars this week together, spur of the moment, and I think it's worked beautifully, and we will be doing more. That's why we started to number them, because we assumed that we were like, oh, what are we going to call this one? The other one was called something else. I said, let's just call it number 2, because there's probably going to be a number 3 and more as well. And then lastly, JC Smalley celebrated her 5th anniversary working here at New Capital Management. We went to lunch today. So if you get a chance, please congratulate JC. She does an amazing job. And so if you do get a chance, just shoot her a note and tell her congratulations. Super, super proud of her. She started here as an intern, a sophomore in college, and she's really, really grown. So that's it. Thank you all very much. And Catherine, I'm going to hand it back to you to sign everybody off.
Okay, everyone, thanks again. Again, enjoy your weekend, enjoy your Friday night. Thank you for joining us. And we will be releasing a recorded version of this webinar as soon as possible on the New Capital website and in the journal. And along with that, as Leonard mentioned, we will be sharing a link to the spreadsheet so you can download that and play with it if you would like. Please let us know if there's anything we can do to help next week or over the weekend. And hopefully we will be talking with all of you soon. Have a great weekend. Thanks.